Now, let's discuss the process of public issue of shares. If public limited company issues share to the general public, then there will be four steps. Step number one, issue of prospectus. Prospectus is a advertising material which is distributed among general public, and it contains all the information related to public internal and external information like name of the company, registered office, nature of business, types of business, the vision and mission statement, the name of board of directors, their education and experience. All the details will be provided in prospectus. Second step will be receipt of application. Those public, those persons who are interested to purchase the share of the company will have to provide application along with application money. Third, allotment of shares. If applications are received in full, then 100% allottees will get allotment. If the shares are undersubscribed, then those persons who have subscribed these shares will get allotment of shares. And if shares are oversubscribed, in their case, company have two options: either to refund the amount of excessive shareholders, excessive applicant, or to adjust the money in allotment money and issue of share in pro rata basis. So, allotment of shares, and last step is call on shares. Company will ask to provide further money as the face value is not demanded in lump sum at the time of application, allotment, first call and final call. This is how company get call money. So there are four stages of public issue. First, issue of prospectus. Then those person who are interested in share of the company will provide application along with application money. Then company will allot shares to the applicant, and lastly company asks for calls on shares to pay the balancing amount due on shares. Now let's discuss the basic accounting entries for issue of shares. As we know that shares are issued in several stages such as application, allotment, first call, second call or final call. So journal entry in each case will be different. For example, first, at the time of receiving application, the journal entry will be bank account debit to share application money account. Bank account debit because at the time of application, the applicant will pay application money, so the amount will be debited. Bank account debit because cash comes into the business, so bank account debit to share application account. Second, application will be transferred to share capital. This application money will be transferred to share capital account. So on transfer of share application to share capital, the entry will be share application account debit to share capital account. Remember, on receipt of application, share application will be credited. Then later on, at the time of transfer of share application to share capital, share application will be debited. Therefore, share application account or share allotment account, call money account, all are temporary account, because one time we will debit the transaction, second time we will credit the transaction. So it will get set off. Share application account debit, share application account credit will get cancelled. Third entry, on allotment due, the entry will be share allotment account debit to share capital account, similar to previous entry, share allotment account debit to share capital account. And fourth entry will be on receipt of allotment money, the entry will be bank account debit to share allotment account. Remember first entry. Similarly, bank account debit to share allotment account, share allotment debit, share allotment credit get cancelled. Fifth entry, on first call money due, entry will be share first call account debit to share capital account, and sixth entry will be on receipt of first call money, bank account debit to share first call account. All these entries are repeating, similar entries are passing, and on second or final call money due, entry will be similar, share final call account debit to share capital account, and on receipt of final call, the entry will be bank account debit to share final call account. Remember, all these entries are getting repeated. Let's understand with a practical example. If 60,000 equity shares are issued by company and application money is 2 rupees, allotment 3 rupees, first call 3 rupees, and second call 2 rupees. Total 10 rupees is the face value of share. So company has issued 60,000 equity shares and the face value is divided into 4 parts: 2 rupees on application, 3 rupees on allotment, 3 rupees on first call, and 2 rupees on second call. Then what will be journal entry? First journal entry will be on receipt of application money, so journal entry will be bank account debit to share application account. Amount will be 60,000 into 2, 1,20,000, 1,20,000. Second journal entry will be transfer of application money to share capital. So journal entry will be share application account debit to share capital account, same amount. Third journal entry will be on allotment money due. So entry will be share allotment account debit to share capital account. 60,000 share into 3 rupees, 1,80,000 rupees. Fourth entry will be receipt of allotment money, bank account debit to share allotment account. Amount will be same, 1,80,000. Next entry, first call money due. So entry will be share first call account debit to share capital account. 60,000 into 3, 1,80,000 rupees. On receipt of call money, entry will be bank account debit to share first call account. Amount will be 1,80,000, 1,80,000 rupees. And on second call money due, entry will be share second call account debit to share capital account. Amount 60,000 into 2, 1,20,000 rupees. And on receipt of call money, the entry will be bank account debit to first to share final call account, 1,20,000 rupees. So these are the basic journal entries. If shares are issued at premium, then journal entry will be share allotment account debit. Generally, premium money is included in allotment money and it is collected at the time of allotment. So entry will be share allotment account debit to share capital account to share premium account or security premium account. For example, if allotment money is 4 rupees, 3 rupees is actual allotment money and 1 rupee is premium included in allotment money, then and 50,000 shares are issued, then share allotment account debit 50,000 into 4, 2 lakh. To share capital account 50,000 into 3, 1.5 lakh. And premium and to share premium account 50,000 into 1, 50,000. Debit and credit should be equal. So at the time of premium, the entry will be share allotment account debit to share capital account to share premium account. And at the time of receipt of premium, the entry will be bank account debit to share allotment account. Amount 2 lakh, 2 lakh. And if shares are issued at discount, then entry will be different. If shares are issued at discount, then journal entry will be, for example, allotment money is 4 rupees, but 1 rupee is discount and only 3 rupee is collected. Then journal entry will be share allotment account debit, discount on issue of share debit to share capital account. Remember, at the time of premium, if shares are issued on premium, security premium will be credited. But if shares are issued at discount, then discount will be lost to the company. Hence, debit all expense and losses. Therefore, discount on issue of shares will be debited If company has issued 50,000 shares, then 50,000 into 3, 1,50,000 rupees, share allotment account debit. 50,000 into 1 rupee, 50,000 rupees, discount on issue of share account debit to share capital account, that is 50,000 into 4, 2 lakh. Total of debit side is equal to credit side. And on receipt of allotment money, the entry will be bank account debit to share allotment account. Amount will be 1.5 lakh, 1.5 lakh. Amount will be share allotment money which is received, actually received after discount. So we have discussed if shares are issued at par, premium and discount. Journal entry will be, in case of allotment, share allotment account debit to share capital account. In case of premium, security premium is also credited. And in case of discount, discount on issue of share will also be debited. So entry will be share allotment account debit, discount on issue of share account debit to share capital account. But remember, as per new provisions of Companies Act 2013, public issue of share at discount is not allowed. Now, let's discuss the concept of oversubscription and undersubscription. If company issues 1 lakh number of shares and public subscribes 1 lakh shares, if company issues 1 lakh share and public demands 1 lakh share, it is a case of full allotment. If company issues 1 lakh share and public subscribe for 95,000 shares, then it is a case of under subscription. But if company issues 1 lakh number of shares but general public applies for 3 lakh number of shares due to reputation of a company or huge demand of shares. So in this case, company cannot issue more than 1 lakh number of shares. So it is a case of oversubscription. Public has subscribed over more than what is issued. Then this is a case of oversubscription. In this case, companies have two options: either to refund the money of excessive application. For example, in this case, 1 lakh number of shares is to be issued, but company has received application for 3 lakh shares. In this case, 2 lakh applications are more. So company can refund the amount of 2 lakh applications and continue the allotment to the 1 lakh number of shares. Or company can adjust the money in allotment of shares by giving shares in pro rata basis, prorational basis, proportionate basis. It means those who have applied for 3 shares will be given only 1 shares. So in this case, no applicant will remain vacant. All the applicants will get shares, but the number of shares will be different. If an applicant has applied for 3 shares, will get 1 shares. Hence, the public have applied for 3 lakh number of shares, they get 1 lakh number of shares. In this case, no refund will be provided, but the excessive money on application of 2 lakh application will be adjusted in allotment money. The application money on 2 lakh number of shares are excessively received by company. So that money will be either refunded or it will be adjusted into the next round of money, that is allotment money. So in this case, journal entry will be different. So in case of full allotment, no problem, all the applicant will get shares as per application. In case of under subscription, no issue. Those who have applied for the shares will get 100% shares. But in case of oversubscription, if shares are issued for 1 lakh and public have demanded for 3 lakh, in this case company have to make decision either to refund the money which is received in excess of 1 lakh shares, or they have option to allocate the shares in proportionate basis, that is pro rata basis, in particular proportion. So in this case also, either they will provide refund of money, but it is better to adjust the money in next round, that is in case of allotment. So journal entry in case of refund is different, and if the company issues share on pro rata basis, then journal entry will be different. So first let's take case of refund. If company issues share 10,000 number of shares and application received for 15,000 number of shares, and application money 3 rupees, allotment money 2 rupees, and call money is 5 rupees. Total 10 rupees is face value. In this case, journal entry will be first on receiving the application money, bank account debit to share application account. Application is received for 15,000 number of shares. So 15,000 multiplied by 3, 45,000 rupees. And if the money is refunded, the excessive money on 5,000 number of shares is refunded, then the journal entry will be share application account debit 45,000 rupees to bank account to share capital account. The application excessive application is 5,000 shares. 5,000 multiplied by 3 rupees per application. 5,000 multiplied by 3, 15,000 rupees. On credit side, to bank account 15,000 rupees and share application balance 30,000 rupees. That is 10,000 shares issued multiplied by 3 rupees application money. So first entry will be bank account debit to share application account. Application 15,000 multiplied by 3, 45,000, and second entry will be application account debit to bank account to share capital account, because application on the excessive 5,000 shares will be refunded. So 5,000 shares multiplied by application money 3 rupees per share, 15,000 rupees will be refunded. So in case of refund, journal entry will be bank account debit to share application money account, and second effect will be share application account debit to bank account and to share capital account. Second case, In case of oversubscription, if application money is not refunded but it is adjusted in allotment money and companies have issued on pro rata basis. So pro rata basis for 50,000 number of shares, application money is 3 rupees, allotment money 2 rupees and call money 5 rupees. Total face value is 10 rupees. Then first entry will be, and even the shares are issued, application is received for 1 lakh shares, 50,000 issued and subscription for 1 lakh shares. So bank account debit to share application account 1 lakh into 3 lakh. Second entry will be share application account debit 3 lakh to share capital account to share allotment account. Share capital account will be credited with 50,000 into 3, 1 lakh 50,000, and balancing 1 lakh 50,000 will be credited with share allotment account because excessive money will be adjusted in share allotment. So first entry will be 1 lakh into 3, bank account debit 3 lakh because application money is received for 1 lakh shares. So application received multiplied by application money, bank account debit to share application account, and transfer of application to capital, share application account debit 3 lakh. Remember, share application account will be debited with the same amount which is earlier credited to share capital account to share allotment account. How much money will go in share capital account? So issued shares, that is 50,000 number of shares, multiply by application money 3 rupees. So 50,000 into 3, 1 lakh 50,000 rupees. And remaining amount will be transferred to share allotment account. 3 lakh minus 1 lakh 50,000, balance 1 lakh 50,000 will be transferred to share allotment account. Let's check in case of under subscription. If shares are issued for 1 lakh shares and public have subscribed for 90,000 shares, application money 3 rupees, allotment money 5 rupees, call money 2 rupees, total 10 rupees is face value. Then on receipt of application money, the entry will be bank account debit to share application account, amount will be 90,000 into 3 because public have subscribed for 90,000 only. So money will be credited in bank account with 90,000 into 3, 2 lakh 70,000 rupees. Second entry will be share application account debit to share capital account 2 lakh 70,000 rupees. So in case of under subscription, the entry will be normal, but the amount will be 90,000 into 3. The number of shares which a company has received application for and multiply by application money. That is 90,000 shares into 3 rupees. Now let's understand the concept with practical example. NKP Limited issued 60,000 equity shares of 10 rupees each. 10 rupees is face value of per share, payable as 2 rupees on application 3 rupees on allotment, 3 rupees on first call, 2 rupees on final call. The shares subscribed and all the amount due was received as journal entry in the books of MKP Limited. So in this question, 60,000 equity shares are issued and 100% shares are subscribed. Application money is 2 rupees, allotment money 3 rupees, first call 3 rupees, and final call or second call 2 rupees. Total 10 rupees is face value of one share. So pass the journal entry in the books of MKP Limited. So journal entry in the books of MKP Limited. First entry for amount received in cash or application money received in cash. So entry will be bank account debit because bank is the receiver of application money. To equity share application account, amount will be 60,000 equity shares and application money is 2 rupees per share. So 60,000 into 2, 1,20,000 rupees. Next entry, equity share application money will be transferred to equity share capital account. So entry will be equity share application account debit to equity share capital account. Amount will be same, 1,20,000. First entry narration will be being application money received on 60,000 equity shares, and narration for second journal entry will be being equity share application money transferred to equity share capital account. Next journal entry on due of allotment money. So journal entry will be equity share allotment account debit to equity share capital account. Amount will be 60,000 equity shares and allotment money is 3 rupees per share. Amount will be 1,80,000 rupees. Narration will be being allotment money due. On receipt of allotment money, the entry will be bank account debit to equity share allotment account. Bank is the receiver of allotment money, therefore bank will be debit the receiver to equity share allotment account. Allotment account is temporary account. First it will be debited and second time it will be credited. So debit and credit will be cancelled. Therefore it is a temporary account. Amount will be same, 1,80,000 rupees. Narration being allotment money received on 60,000 equity shares. Next journal entry, call money on first call is received at the rate 3 rupees per share. So amount will be 60,000 equity shares into 3 rupees per share, 1,80,000 rupees. Equity share first call account debit to equity share capital account. The journal entry is for on due of first call, 1,80,000 rupees debit side, 1,80,000 rupees credit side. Narration will be being first call money due on 60,000 shares, and next entry will be on receipt of first call money, bank account debit to equity share first call account, and amount will be same, 1,80,000 rupees. And finally The second call money due entry will be equity share final call account debit to equity share capital account on 60,000 shares at the rate 2 rupees each. Entry will be 1,20,000 rupees 1,20,000 rupees being final call money due on 60,000 shares, and last journal entry will be bank account debit to equity share final call account on receipt of final call money. Amount will be same 1,20,000 rupees. Narration will be being final call money received on 60,000 shares. So this will be journal entry. First two journal entries for application money. Third and fourth entry is for allotment money. Fifth and sixth entry is for first call money. And seventh and eighth entry is for final call money. In this question, Ankita Limited offered public issue of 10,000 equity shares of 10 rupees each. This is the face value. At a premium of 12 rupees each per share. This is issue value. Total number of shares issued 10,000 number of equity shares. Face value is 10 rupees and premium is 2 rupees per share. So issue value is 12 rupees. On application 4 rupees, allotment 4 rupees including premium. So application money is 4 rupees. Allotment money is 4 rupees. Out of 4 rupees, 2 rupees will be credited to capital account and balancing 2 rupees will be premium amount including premium. On first and final call, balance amount. So call money is 4 rupees. The company issues share at 12 rupees. Company received all the money. The issue was fully subscribed. Give journal entries to record the above transaction and also show balance sheet. So in the balance sheet, liability side, issued share capital will be 10,000 equity shares of rupees 10 rupees each. So amount will be 1 lakh and security premium will be 10,000 into 2 rupees per share premium. So 20,000 total 1,20,000 rupees. And on the asset side, cash bank account will be recorded at the rate 1,20,000. It includes both the money, equity share capital account as well as security money. Let's start with journal entry. In the books of Ankita Limited, first entry will be on receipt of application money on 10,000 equity shares, 4 rupees per share. The amount will be 40,000 rupees. Entry will be bank account debit to equity share application account. Application money received in the bank. So bank is the receiver, bank account debit. Amount will be 40,000 rupees. 10,000 equity shares of 4 rupees each. Second journal entry for transfer of application money to equity share capital. Amount will be same. For first entry, narration will be being application money received on 10,000 equity shares, and narration for second entry will be being application money transferred to equity share capital account. Next journal entry on allotment. Allotment money is 4 rupees and 2 rupees of premium is included. So entry will be equity share allotment account debit to equity share capital account to share premium account because premium of 2 rupees is included in the allotment money. So amount will be 10,000 equity shares at the rate 4 rupees each. 40,000 rupees is amount allotment money. 2 rupees will be transferred to capital account and 2 rupees is premium per share. So 10,000 into 2, 20,000 rupees will be security premium and balancing 20,000 rupees will be transferred to equity share capital account. So entry will be equity share allotment account debit 40,000 rupees to equity share capital account 20,000 rupees to share premium account or security premium account 20,000 rupees. Narration being allotment money due with security premium of 2 rupees per share. And next journal entry will be on receipt of allotment money amount 40,000 rupees on the debit side, 40,000 rupees on credit side. Narration will be being allotment money on 10,000 equity shares received along with 2 rupees equity share premium. So first two entry will be for application money received. Third and fourth entry will be for allotment money. Now fifth and sixth entry will be for first call money received. So first call money due entry will be first call account debit to equity share capital account. Amount will be 10,000 shares of 4 rupees each, and this is first and final call. So entry will be equity share first and final call account debit to equity share capital account. Amount will be 40,000 rupees on the debit side and 40,000 on credit side. Narration being first and final call due on 10,000 equity shares, and last entry will be bank account debit to equity share first and final call account on receipt of first and final call money. Amount will be same. Narration being call money received on 10,000 equity shares. Completed. Next, Ashwini Limited invited application from the public for subscribing for 10,000 equity shares of 15 rupees each at a discount of 1 rupees per share payable, 5 rupees on application, 9 rupees on allotment. All the shares were applied and allotted. Money due on allotment was received. Now, Ashwini Limited invited application from the public for 10,000 equity shares and face value of 15 rupees each at discount of 1 rupees. 5 rupees will be payable on application. Application money is 5 rupees and allotment money is 9 rupees. So total amount will be 14 rupees plus 1 rupees discount. So total face value is 15 rupees. So what will be entry for application money received? Bank account debit to share application account. Amount will be 10,000 into 5, 50,000 rupees Second entry will be application money transfer to equity share capital account. Application account debit to equity share capital account. Amount will be 50,000. Third journal entry for allotment money due. Entry will be equity share allotment account debit. Discount on issue of share debit to equity share capital account. Allotment money is 9 rupees per share. So 10,000 into 9, 90,000 equity share allotment account debit. Discount is a loss for the business. So discount on issue of share will be debited, debit all expense and losses. Therefore, discount on issue of share will be debited with 1 rupees discount on 10,000 equity shares. Amount will be 10,000 into 1, 10,000 rupees, and total 1 lakh rupees will be credited to equity share capital account. Being equity share allotment money due and discount of 1 rupee per share applied. And on receipt of allotment money, bank account debit to equity share allotment account. Amount will be 90,000, 90,000. Amount will be debited with balance money after providing discount, that is 90,000. Equity share allotment account debited with 90,000 and it will be credited with 90,000. So debit and credit will get cancelled. So temporary account will be closed. Next, Vaishali Limited issued 10,000 equity share of 10 rupees each. 10,000 equity shares. 10 rupees is face value at par. Par means face value and issue value both are same. 10 rupees face value issued at 10 rupees only. Payable on 3 rupees on application, 4 rupees on allotment, and 3 rupees on first and final call. Application money is 3 rupees, allotment money is 4 rupees, and call money is 3 rupees. Total 10 rupees is face value and issue value. The company received application for 15,000 shares. Company has issued 10,000 shares, but application received for 15,000 equity shares. Means public has applied for 15,000 equity shares. So application money will be recorded on 15,000 shares. The board of directors rejected 5,000 application. It means the board of directors rejected excessive share applications because the shares are oversubscribed. 10,000 equity shares are going to issued by the company, but public has subscribed for 15,000 shares. 5,000 shares are oversubscribed. So board of directors decided to reject and application money was refunded. Application money of 3 rupees per share and it will be refunded on 5,000 equity shares and all the money was duly received. So what will be journal entry? First entry will be bank account debit to share application account on receipt of application money. Application received for 15,000 shares and application money is 3 rupees per share. So amount will be 15,000 into 3, 45,000 rupees. Being application money received on 15,000 equity shares. And the directors have decided to refund the money on excessive 5,000 application. So entry will be equity share application account debit to equity share capital account. to bank account. If equity share application account will be debited with 45,000 rupees, which was previously credited. Now, application money is refunded on 5,000 equity shares. So 5,000 equity shares and application money is 3 rupees. So amount refunded is 15,000 rupees, and balancing amount, that is on 10,000 equity shares at the rate 3 rupees, will be credited with to equity share capital account 30,000 rupees. So entry will be equity share application account debit to equity share capital account to bank account. Out of total 45,000 rupees, 15,000 rupees was refunded to the excessive applicant and balancing amount transferred to equity share capital account. Narration will be being application money transferred to equity share capital account and application money on 5,000 shares was refunded. Next journal entry on allotment money due equity share allotment account debit to equity share capital account. Amount will be 10,000 equity shares at the rate allotment money is 4 rupees per share. So 40,000 rupees will be allotment money. Being allotment money due, and on receipt of allotment money, the entry will be bank account debit to equity share allotment account. Amount will be 40,000 rupees. Narration will be being allotment money received on 10,000 equity shares, and next journal entry will be for first and final call money 3 rupees. So entry will be on receipt of, so entry for first and final call money due will be to equity share first and final call account debit to equity share capital account. Amount will be 10,000 equity shares at the rate 3 rupees each. Total 30,000 rupees will be debited and credited. Being first and final call money due on 10,000 equity shares, and last entry on receipt of first and final call money, the entry will be bank account debit to share first and final call account 30,000 rupees. Narration being first and final call money received on 10,000 equity shares. So first and second entry will be on application. Board of Directors decided to refund the excessive application money. So 5,000 shares were oversubscribed. The amount is refunded to the applicant. Third and fourth entry is for allotment money, and fifth and sixth entry is for first and final call money. So let's now continue with call in arrears and call in advance. So first we will learn about call in arrears. Arrear means outstanding. The amount is payable. So in case of call in arrear, the journal entry will be, first entry will be equity share first call account debit to equity share capital account, and second entry will be bank account debit call in arrears account debit to equity share first call account. Remember, there are two journal entries for each transaction. Equity share first call account will be debited to equity share capital account, the normal journal entry. So we will provide normal journal entry on first call money due, and second journal entry will be bank account debit, bank account debit if amount is received, call in arrear account debit, shares on which the money is not received, and total amount. So for example, if 10 rupees is face value of share, 10,000 equity shares are issued by one company, and out of this 10 rupees, 8 rupees received on all the money, 8 rupees is received, and 2 rupees is call money. Out of 10,000 shares, 500 shares, the applicant of 500 equity shares has not paid 2 rupees of call money. So what will be journal entry? 10,000 into 2 rupees, 20,000 equity share first call account debit to equity share capital account on call money due. The narration will be being call money due on 10,000 equity shares, and on receipt of the money on 500 shares, 2 rupees is not given. So 500 shares into 2 rupees per share, that is 1000 rupees, is call in arrear. Out of 20,000 rupees of call money, 1000 rupees is call in arrear. So balancing amount will be 19,000 rupees bank account. The amount is received. What will be calculation of 19,000 rupees? So call money was not received on 500 shares. So balancing shares are 9,500, and 2 rupees per share is call money. So the amount will be 19,000 rupees. So entry in case of call in arrear will be equity share capital, equity share first call account debit to equity share capital account. First entry will be common for all, and second entry will be bank account debit, call in arrear account debit, because the money is not yet received, so it may be loss for the business, so it is debited. This is the notional loss. Temporary account to equity share first call account, previously it was debited, now it is credited with 20,000 rupees. Now if in case of call in advance, the first entry will be same, but second journal entry will be credited with call in advance. If call in arrear is there, then it will be debited. In case of call in advance, if one applicant of 500 share is given 2 rupees in advance, then the entry will be bank account debit to equity share first call to call in advance account. So next concept is call in advance. It means one of the applicant has given call money in advance at the time of allotment, along with allotment. For example, 10,000 equity shares. Company has issued 10,000 equity shares of 10 rupees each, and one applicant with 400 equity shares has paid full money at the time of allotment. The classification of this 10 rupees is application money 2 rupees, allotment money 5 rupees, and call money is 3 rupees. Total 10 rupees. First journal entry will be on application money received, bank account debit to equity share application account 10 into 10,000 into 2 rupees, 20,000 rupees. Second entry will be equity share application account debit to equity share capital account 20,000 rupees. Third entry will be on allotment money due 10,000 equity shares into 5 rupees each. So entry will be equity share allotment account debit 50,000 to equity share capital account 50,000 rupees being allotment money due, and on receipt of allotment money along with advance call money, the entry will be bank account debit to equity share allotment account to call in advance account. So equity share allotment account will be credited with 50,000 rupees. Previously it was debited. Now bank account will be debited with 50,000 plus call in advance. It means call money is 3 rupees and allotment and call money on 400 equity shares received in advance. So 400 into 3, 1200, 51,200 rupees bank account debit and call in advance is 1,200. So entry will be bank account debit 51,200 to equity share allotment account 50,000 to call in advance 1200. Because it is received in advance, it will be liability for the business. So all the liabilities have credit balance. Any money received in advance will be liability for the company. So narration will be being allotment money received along with call money on 400 equity shares, and last entry for call money will be equity share call account debit, equity share first call account debit to equity share capital account on receipt on call money due. Amount will be 10,000 into 3 minus 1200, 30,000 minus 1200, 28,800, because already call money is received in advance on 400 shares, and last entry will be bank account debit to equity share call money and amount will be same 28,800.